What's going on in the markets? And what is direct indexing? We handle it all today. You're going to want to listen all the way through.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement Podcast. This being the first Monday of the month, we're going to really kind of break down what's going on in the markets a little bit, as well as we have a guest that we're actually having on, Brooke Garcia, that we're going to segue over into an interview with her after Merce and I kind of talk a little bit about what's going on in the market. We feel this is important because many of our listeners, they come to the show and really they're trying to, get different ideas. And we thought, why don't we take the first Monday of the month and really kind of talk about what we see going on in the markets, what's driving things, maybe some things that we're doing to shift, and then maybe share an insight with you about some of the different levels of management we have. So let's start this off, Merce. As we think about what's going on in the markets right now, it's, I think, surprising a lot of people because, I think at any point people have been thinking the markets are going to pull back, and no matter what we have going on in the world, seems like the markets are just going up. So what's kind of some things that you see happening?
Yeah, I know. It seems like every other day you're logging in or however you look at the markets and you see a headline for hitting new highs and hitting new highs, and that's exciting. And I don't think anyone thought we were going to be where we are, given everything walking into the year with the administration change and inflation issues that we've been seeing. So there's a lot of positives that I think we've seen here over the last few months, but I think there's also some things of caution that we can talk about as well. I'll talk a little bit about the Fed because that's been a big driver of what's been going on in the last few months. We walked into the year with issues around interest rates, issues around inflation, and then finally, as we sit here about a month ago, we got our some rate cuts coming down the line, and projected a couple more by the end of the year. So the markets have benefited from that. Interest rates going down helps the smaller companies and the middle-sized companies, and so we've seen some recovery in those small cap and mid cap types of areas because lending is a little bit easier for them now with rates going down. So that I would say is a positive in that direction. The Fed has been wanting to get rates down. It's been a tricky area, sticky inflation, all these buzzwords that we've been hearing, but rates are coming down, so that's a nice one.
Yeah, and I'll speak a little bit on, a lot of what we're hearing right now. Well, there's two major issues, and we can kind of hit on both of them. One is the government shutdown, and I think the other one is what we see going on with the trade talks. As we're recording this, the President Trump has just met with the president of China, and they have been trying to negotiate tariffs. And the feedback is things seem to be in a good, positive way. But we know how that is. It could be positive today, and by the time you're listening to this, it's all negative again. So the reality is, I think that some of this stuff, whether it's the government shutdown or tariffs, I really believe that the investors have really kind of become numb to this, what used to be very alarming news. I mean, 10 years ago, these things would have been just sending the markets into a spiral. And today it seems to be, not that big of an issue. And I say all that to say that as the markets move up, obviously you've got a risk of a pullback. Do we see things right now on the horizon that says we're going to have some humongous sell-off? It doesn't appear that way. Are we set up right now to have some type of a pullback, and that could be a 5 to 10% pullback? Yes, I think that's possible. But I think that just drives us maybe to talk just a minute, Merce, about just to remind our listeners, you talked about your topic. We could talk about government shutdown, but just to remind with our portfolio design, because I think, especially for the podcast, we've not shared this on a regular basis, but just to kind of maybe give just a brief overview of how we set the portfolio up to be able to navigate or be able to withstand some of these market condition changes as they might come.
Yeah, and I think I was listening to something on my way in to work here in the car, and it was talking about Nvidia, and Nvidia is being the craze, and there's been this talk about the AI bubble that we're potentially in. Nvidia just hit a valuation of $5 trillion as a company. That's the setting records by itself. And so sometimes we get the question of, well, are we in a bubble, and what's my investment strategy for it? So here's our stance on how to invest, especially when it comes into retirement. We want to have balance, and we want to have not just diversification, but also de-risking through different types of asset classes. So not just having all the pieces of the stock market, we also look at different alternatives within the stock market and outside of the stock market. So when it comes to strategy, we have our core strategy, which is really designed to just kind of move along with the benchmark or the indexes itself. So if the markets are up, this is going to do well. If the markets are down, this is going to kind of follow. So, but it's the core, because we know long term the stock market does well. We'll have some changes to that over time, but the idea is to be tracking the market to a degree. And then where risk management comes into play is we've got a tactical strategy that is equity based, but it's going to be one of those things where if the markets are going well, then we can put our foot on the gas. But if there are issues, then we can make adjustments within the funds, within the portfolio itself, to risk mitigate. That doesn't mean that we're going to cash, right? That's a thing that can be debated all day long, but there are ways to reduce risk without going to cash these days. And then outside of the equity side, then we've got traditional bonds. You got to have bonds if you need to de-risk, and they've proven to be a little bit not as productive as they used to be 10 years ago. So for that reason, we like alternatives as well. Liquid alternatives within the portfolio that are there to generate return, whether through income or growth types of oriented funds. But the key here is that they're not related to the general stock market. So they're zigging and zagging in different ways than the stock market is, which is especially important at times of volatility or an AI bubble, or when the tariff things that we've been going through. So having different asset classes working for us at different times is going to help smooth out when we do have issues. And then if we're in a place where we qualify, we can go into private investments completely outside of the stock market and get exposure to things that are not as subject to just daily trading and headlines that can rock the stock market. And then we talk about a whole different area of safety, which is in the fixed index annuity space to truly offset risk and serve as a bond alternative. The nice part here is that we get a promise of that our asset cannot go down if the markets have issues, and we're still going to make a decent rate of return. So you blend all those big strategies together, and now we've got true risk management, not just buying a handful of stocks and a handful of bonds, different strategies working together in different ways.
Yeah. All right. So let's do this. First Monday of the month, we've kind of given you a nice overview, but we're excited right now because we conducted an interview with Brooke Garcia. She is a CFA, which is a chartered financial analyst, and she is super smart. And we asked her to explain to you how we do what's called direct indexing with a tax overlay. How can we actually do this and manage money outside of an IRA in the most tax efficient way? You're going to want to listen to this interview all the way through. Go ahead now. Let's give your attention to Brooke Garcia. Thank you so much, Brooke, for coming on and talking with us today on a topic that we wanted to make sure that we could share with our clients. And in fact, if you've not met Brooke, Brooke is a part of our team when it comes to helping us build out our portfolios, help us make sure that we do all the due diligence, and she has all of the credentials to make sure that this all gets done correctly. So Brooke, we appreciate you coming on, and we wanted to talk about a topic that we have been explaining to our clients, those that are coming on board, and it's really this idea of how can we make a non-IRA account more tax efficient. And I'm just going to, before we go into the nitty gritty, what people know is if I buy a stock and I hold that stock for more than a year, I get long-term capital gains, which means I'm only going to pay a much lower rate, usually around 15% on that tax, which is better than if I sell it within the year. The problem is if I get a really good stock, I could get myself into a position where now I've got a huge gain and I start saying, I don't want to sell that stock because I got this big gain. And then I go, well, now I'm not diversified, right? And so there's some problems there. So we have been helping our clients through, the technical term is direct indexing, but really I say it is a tax efficient portfolio. So could you talk a little bit about what this is and how it works a little bit and why people might want to think about it?
Yeah, absolutely. So to try and explain it as simply as possible, if you could go out today and you could buy SPY, you could buy the S&P 500 index fund, right? You're going to pay like 3 basis points for it. And if you invest in that, you are simply tracking the performance of the S&P 500. I think it's important to note, I mean, you said you buy Apple or whatever. 40% of the S&P 500 today is made up of 10 stocks. So 10 out of those 500 make up 40% of the index. That's a
When you say make up, you mean make up the return of the index?
Yes. So it a lot of people have gotten themselves into this exact situation where they've got huge gains, and if they sell it, they're going to have a pretty hefty tax burden. So direct indexing essentially is a way to buy those individual stocks. Instead of buying an ETF like SPY, you go out and you buy the individual stocks. So there's actually no cost associated with buying those stocks. But you may not buy all 500. You might buy, for example, 50 stocks. But there's a way that we can use technology to optimize which 50 of those stocks you buy so that you track very, very closely with what the index does. So if the S&P 500 goes up 7%, you're up 7.1 or 6.9. And so over time, you're holding those individual stocks. And there's a benefit to that, which is that not every stock that you're holding is going to go up. A lot of them will go down. And that's okay, because what happens is when they go down, we can sell those stocks that have gone down. And that gives you sort of a buffer on your tax burden, hopefully that's a good way to explain that. And so the purpose is that you're just trying to track an index, and it doesn't have to be the S&P 500. It can be any custom index that you all want to use. But the purpose is you are just trying to track the same performance as that index, but you're able to do so and then take advantage of opportunities to harvest losses, is how we say it, to offset your tax burden.
So, funny story, or just a client experience story, I guess, was we got her into this type of investment strategy, direct indexing with tax loss harvesting. And the way I explained it to her was basically that, right? We can replicate the index, the S&P 500, for example, by only using 50 to 75 stocks, not having to buy all 500 stocks, still get the return of the index because we replicated it. But also now there's this tax benefit of when there is a loss or a stock that's not performing, which happens all the time, but somehow the markets still go up, but you still have losers. So now it's kind of like we want these losers. We kind of get to take advantage of these losers a little bit and harvest that loss. And so we ended up meeting, I think, 6 months later to kind of talk about the strategy itself. And so I explained to her, I said, here, and I drew the numbers on the board of here's what the dollar amount we started with in this account, and here's what it's worth now. And the funny part was I also showed her the loss, and she said, how is it possible that I made money and I lost money at the same time? And I said, that's the beauty of it, right? You went up the same amount as the index itself, but now on your tax return, we just harvested a loss for, make up a number, but $6,000. That's going to benefit your income tax. And she's like, wow, okay, I get it. So that was efficiently managing a non-IRA account, non-qualified account. This is a really cool strategy for it. Why hasn't this been happening all the time? Like, why is this becoming such a popular thing today now more than, say, 10 years ago?
I actually don't know if I have a great answer for that question. There have been a couple of companies that have been around for a number of years that have been able to do this. I would say technology advances have certainly made it a lot easier to employ this type of strategy. That would probably be what I would say is the primary driver. But there is a ton of value to be gained, as you mentioned, through being able to harvest those losses and basically provide that extra tax alpha.
Yeah. I mean, I think a big piece of it is the technology. If we didn't have the technology to track this, I mean, can be, if you're listening, it's like, well, it's kind of complicated. We're replicating, we're doing the stocks, we're selling the stocks, getting the loss.
I think that replication part is the tricky part, because anyone can go out and say, okay, I'm going to look at my portfolio today and, oh, look, I see that stock is at a loss. I'm going to sell it. What do you buy to be able to actually replicate the index, because by doing that just manually, you run the risk of underperforming the index because you didn't buy the right thing to get close enough with that sort of band of tracking error around what the index is doing. And so anyone can harvest losses, but can you replicate the index at the same time?
Right. And so that's what I think it is that, today with technology, there's just much better ways to track all this. Whereas before it was a manned type of strategy. And, how many can one person do for their clients, right? They're
100%.
going to make mistakes, right?
Yeah.
So it didn't work.
Yeah,
back
you
then.
couldn't scale.
It works really well now. So I thought it was just a cool story. She said, how did I make money and lose money at the same time? Well, that's the beauty of this. So that's one example, but kind of walk us through maybe a couple other examples of how this could be a really good strategy for someone. Say I've got someone that worked at, I don't know, IBM all their life, and they've amassed $1 million in IBM stock, and they feel handcuffed to it, like Radon said, because I don't want to sell it. It's grown well, and I know I'm overexposed here, but I just can't handle the tax impact here. So how do we handle that type of scenario?
Yeah, I mean, assuming that you have stock other than IBM, we're going to go with the IBM example. Assuming that you've got other things in the portfolio that can be combined all into one account, then you can start to, over time, sell that IBM slowly to get it closer in line with the benchmark. But at the same time, you can be harvesting losses from the rest of the portfolio. So you're using those losses from all of the other stuff that's in the account to be able to offset and slowly sell your IBM down. Now, in a case like that, where you've got a really highly concentrated position, maybe it's 70% of the account, you're not going to be able to track the index as closely. So your band around your tracking of the index is going to be quite a bit wider, because you just don't have the ability with 30% to make up the difference. But over time, as that position is sort of whittled down and sold down slowly, you can get more and more close to what the benchmark actually looks like.
Yeah. So, I've been doing this for some time now, and I see those, because again, this is a whole team here that's doing this, and so I've been able to see those trades come through where we've been harvesting it. But could you give us maybe a little bit of an idea of what you've been seeing, and I'm not trying to quote an actual rate here, but just give me a little bit of a band of range of what we've been seeing, what we call it, this tax alpha, and what that means.
Yeah. So we've done some math. We've looked at some accounts. Long term, we think about 1% is basically the added value, that tax alpha that you can get. Obviously, it's very client specific, but in general, that we're kind of thinking about 1%.
Yeah, that's what I've been seeing on my account as well, and I think it's just something that is a strong advantage. I do want to just talk about, because a lot of this is about the tax advantage, but I want to talk about one other area, that the idea of us mimicking an index like you're describing here, without having to go buy 500 stocks, where we could even utilize this in a qualified account now.
Mm-hmm.
And I'll give the story. We had a lady now client come in, and she just was like, for her reasons, did not want Tesla, right?
Mm-hmm.
She said, I don't want Tesla in my portfolio. Well, if I buy a mutual fund or an exchange traded fund,
you're going to hold Tesla.
I'm going to hold Tesla, right? And there's no way for me to carve it out of that exchange traded fund.
Yeah.
And then, if I say, I still need to have diversification, and I still want to, track some type of index, how do I do that, right?
Mm-hmm.
So could you kind of explain how we could be able to do that if you had a person who, for whatever reason, they have a stock they don't want, but we still kind of want to track the index?
Yeah. So I'll start by just differentiating that there's sort of two layers to this. There's the direct indexing piece, and then there's the tax loss harvesting piece. In an IRA, qualified account, tax loss harvesting makes no sense, right? So you don't need that extra overlay, but you can still direct index within that qualified account, within that IRA. So that's a perfect example of where you would come to us and you say, hey, I want to track the S&P 500, but I don't want to own Tesla. We do have the ability to customize that. It just goes off the buy list. It goes off the list as a potential. Now, if you want to start customizing really heavily by excluding a lot of names, it's going to make it more difficult to track the index. So you're going to have a little bit wider band around, kind of like, rather than 6.9 or 7.1, if the index is up 7, you might be at like 6.2 or 8.6, something like that. But we are able to customize for whatever reason that a client says, I do not want to own this name or this name. We can do that for them.
Excellent. Well, I think that the idea here is if you have money, and I'll say first and foremost, outside of an IRA, and it's not a part of that IRA, and I'm trying to get it to be efficient, direct indexing could be a really good source. Do you have anything else, Merce, on that topic?
No, I mean, what I got from Brooke is it can be a really good tool for customization, right? So if I don't like a particular stock or whatever, I can kick it out, right? So that it's more available. It's possible to do that today better than ever has been possible. We still get good growth, or we get the growth of what the market or the index that we're tracking, right? Not always going to be necessarily good growth because markets are always going to have issues. But the biggest benefit I see out of this as well, we get the growth plus some tax mitigation and some tax strategies here that I think are pretty cool. So,
yeah, one thing I might mention too, that this is a common misconception or a common point that we clarify a lot. We say we're tracking an index. We still very regularly have clients come to us and say, "Why do you own United Healthcare? It's a dog. Why do you own Walgreens? There's so much bad press about it." Because we're not picking. We're not going in and saying, we think that this and this and this are the stocks that are going to win. We're not doing that. We are just trying to replicate the index. And the index is made up of winners and losers. So it's super important to know that if you look at your account and first of all, you're like, I have all of these stocks that have gone down. I have losses on all of these. First of all, in this case, that's a great thing because we can harvest those losses to provide that tax alpha, but also we're not making fundamental calls on the underlying value of the companies. We're just trying to passively replicate something. So that's a very common misconception that no one is doing fundamental research on the back end and saying we think that this is good or this is bad. We, as you mentioned, markets are going to go up, they're going to go down. We're just trying to perform right in line with them.
Yeah, that's a really good point. We're not stock picking here.
Mm-mm.
Yeah, I thought
Plain and simple.
This is. I mean, because I look at my account and I go, "Ha! I got some losses. That means I'm going to do some harvesting." You know, so it's actually you get to view the losses a little bit different. You know, because you're like, okay, this is going to be good for me to get off some of those bigger things that have had such a big run up and with big huge gains on them. So, well, thank you very much, Brooke. This is always insightful. We appreciate you coming on and giving us your thoughts on all this.
Of course, thank you.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.